weekly market outlook and high impact economic indicators. Welcome to ACY Securities. I'm Ira Reyes, Macroeconomic Strategies. Today we're going to focus on central banks meetings, their impact across the financial markets, and energy update for this quarter, which has been drawn the attention of market movers. So, for our disclaimer, just a reminder, this isn't a financial advice. This is simply my personal view of how I read the market movements. Trading always involves risk. There are no guarantees, so make sure you manage your risk properly. My strategy integrates macro fundamentals with technical execution. By cross-referencing market shifts against statistical data, I execute high-conviction trades designed for optimal expectancy. So let's begin with our recap first. Okay. So last week, let's have a review of what happened on the closing in the New York session as well. So the financial performance of several global stock market indexes of evening in April 24, that would be on the Asian time zone. So domestic markets show a dividend trend with the S&P 500 and Nasdaq posting gains while the Dow Jones Industrial Average experienced a slight decline. International markets also displayed mixed results. You can see in Nikkei 225 and Shanghai, wherein it features a growth in the indices losing in at the same time on alongside, and the FTSE and Shanghai exchanges. Additionally, we have the VIX. This is the Chicago. Yes. So the VIX, which serves as a primary measure of market volatility, we saw a decrease of over 3% during this period. This snapshot offers a comprehensive look at investor sentiment and economic activity across major international trading hubs. Collectively, the data illustrates a day of moderate fluctuation throughout the global financial landscape. So here we also have the performance of the three indices, which is the Dow Jones, S&P 500, which the text right now, technology is pulling right now the industrials. Now let's move forward with our economic calendar this week. So these are the high impact economic indicators. Right now we are focusing on the interest rate within the week. So let's begin first with for today's on the Monday report. So we have the Germany, the GFK. Okay. So we have the GFK consumer confidence. So looking at this report, how it would impact the Euro USD. So this indicator, it shows how optimistic or pessimistic German consumers feel about their finances and the economy. So the actual reading is actually negative 28.0 last time, and since 0 is the long-term average, any negative number means consumers are feeling pessimistic. So what is the sentiment on this report? So the last actual reading, which is negative 28, the trend, things got worse recently, which is you can see on the Euro USD chart as well. So the previous was negative 24.8, and the market expected the forecast would be negative 26.5. Because the actual result is negative 28 was lower than both, it shows a miss in economic health. So that you will see as well on the index of the JER 30 how this consumer confidence affecting across the financials. And on the historical data, you will see on the bar chart, this one, the green and blue. So these are below the 0.00 line here. So what does it mean? So the German consumer confidence hasn't been positive for at least a year, and the bars have been dipping lower since early 2026, indicating a worsening trend in the consumer mood. The consumer mood is highly impacted as well by the energy costs that I have multiple times mentioned. So again, the market impact. you will see on the Euro USD on the Forex. So here on the candlestick chart, this shows the Euro USD paired with the US dollar, and they reacted in 1 hour chart after the last release. So what happened on this one, you can see this one on a red candle. After an initial tiny spike, so the green candle with the blue arrow, here the price started dropping, which is the red candles, two red candles right now. This suggests the weaker consumer data usually makes the euro lose value against the US dollar. And even here on the line chart that we see right now, Euro USD and the event, this compares the consumer confidence, which is the green line, and against the Euro USD, which is the blue line. So what is the correlation of this chart, the bar chart, line chart? So the correlation is that you can see that the green line, it drops sharply, and the blue line, which is the currency value, it often follows its down shortly after. So probability statistics of what could we see the scenario of the Euro USD. So for this one, when the data comes in worse than expected, there is just a 71.43 probability that the euro will decline in value. And if there's an over forecast, the data were to come in better than expected, that means there's a 66.6 probability the euro would rise. Next, we have the Japan interest rate decision as well. So, okay. So this one will be on the upcoming news. Would be on April 28th. That would be tomorrow. So this is a major event for the central bank and decides how much it costs to borrow money in Japan. So it is on the status quo right now because last March 19, the BOJ kept the interest rate at 0.75%, and this was exactly what the market expected, which is the 0.75%. Looking ahead, the next decision that would be tomorrow, market expects to stay the same at 0.75%. So historical data, looking at the bar chart, you can see a clear step in the late 2025. So what is the trend for this is that for most of 2025, the rate was lower, that is 0.50%. Around December, it raised to 0.75%, and it has stayed flat ever since. This shows the central bank or the BOJ move away from their famous near zero interest rate policy recently. And what is the impact on the yen over USD JPY? On the 1 hour chart, you can see how it was moved right after the March meeting. So the reaction, even though the rate did not change, the market was still volatile because all interest rates in announcements always gives us a signal wherein we have to be very cautious. We have to check the volume of the transactions. Sometimes you will see some trade gaps, particularly even in July when there are second quarter results of corporate announcements. So for this one, the reaction, even though the rate did not change, the market was still volatile. The price initially went up, so the stronger dollar and the yen got weaker. Then it sharply reversed and fell. This often happens if the bank's speech after the meeting sounds different than what people expected. That's why we always look on how the inflation rate would go beyond the expectation, and that's the time that we can decide if we expect the currency to become bullish or bearish. So we have here, this is the USD JPY and the event. So the green line represents the interest rate, and the blue line represents the USD JPY exchange rate. So by observation this, notice how the green line step up, and the blue line also trended higher overall. Generally, changes in interest rates act like a magnet for the value of currency. So interest rates, to be exact, they are the market movers. Next, we have the German inflation rate. This one. So just like what we are always looking forward before any interest rate decision. So we look on the inflation rate first. So this measures how much prices for things like food, energy, and housing have gone up compared to the same last year. So here we have a recent spike on last March 30. There's a recent spike. So there was a big jump from the previous month's 1.9%, and it went to 2.7%. So looking ahead, we expect, or the experts forecast this to climb even to 3%. So that's a big jump, from 2.7 and then 3%. Again, 3% is actually critical at this period because everyone is being dragged by the energy costs. And then the text here notes that housing and energy make up the biggest slice of the 32% of what causes these price changes. So here on the historical data or the bar chart, it shows that inflation was mostly steady or falling throughout last year. So it's around 2%. Now, you expect right now to jump 3%. So the trend starting on the early 2026, even before the war, the bars began to grow taller. This tells us that the cost of living in Germany is currently accelerating. So before the war, it was already accelerating. Number one is that we have to look on the atmosphere or the climate change. Usually, it is one given an impact across the trend. Next, the market impact for the Euro USD. So here on the 1 hour chart versus the euro versus the US dollar, so the reaction when the 2.7% was released, the price initially dropped sharply, which is we see the red candles here. However, it also recovered. So this suggests that while high inflation can be sometimes giving us the fear or drive the markets become scared, it also makes traders think that the central bank might rate interest rates to fix it, which eventually helps the euro. So on this event, again, the green and the blue line, the green line is the inflation rate and the blue line is the euro USD price. So notice that inflation is skyrocketing back up. The currency or the blue line is struggling to keep up and has been trending slightly lower recently. So what is our probability on this is that if it's under forecast, if inflation is below the 3%, then there is a 70% the chance that the euro will decline because inflation should always support the currency. And the actual or the forecast, if it is it hits exactly the 3%, historical data would have a 100% decline probability for the euro in the hour following the news. And if there is an over forecast that is higher than 3%, 50%, 50-50 on whether the currency goes up or down. Next, for the United States, we also have high impact data, which is the US house building permit. So these are just preliminary but high impact data. So for this one, it would affect the S&P 500. So US building permits, to give an intro about this, we look ahead for the economy. It counts how many people got permission to start building new houses. More permits usually mean the economy is healthy because people are spending money and building for the future. That means we are looking or targeting the COLA or the cost of living adjustment in the United States. So for here, the recent is there was a miss in March 12, and the number was 1.376 million. So this was lower than 1.41 million people expected and lower than the month before. This tells us that the housing market has cooled down a bit recently. So what we're looking forward is that the next report, that would be on 29th, experts think that the number will drop even further to 1.36. Why do we expect it might even drop? Because of the recent status of what happened on the geopolitical tension at the same time impacting the prices. So for the historical data, Again, this blue and green bar that we're looking at. So the trend, however, the last blue bar, that is the actual, is shorter than the green bar and the previous blue bars. This shows a recent dip in momentum after a relatively strong start to 2026. So what is the market impact on the S&P 500? So why S&P 500? S&P 500 is a big group of US stocks and reacted after the last report, wherein we see on the raw materials during the house building permits. So the reaction of the index is that when the weak permit data came out, the stock market went on a you can see this like a roller coaster. It tried to go up at first, but then it crashed, which means the red candles. This happens when investors worry or there is a market driven fear that fewer houses being built means the whole economy might be slowing down. And that's what we're looking forward if there's gonna be a status of stagflation once the Fed announces its decision. And for that event, again, here the line chart. So the green line is the buildings permit trend and the blue line is the S&P 500 price. By observing that, notice that while building permits, that is the green, have started to tilt down recently here, the S&P 500 has been climbing quite high. So this gap is considered like interesting because it shows stocks are doing well even though the housing data is getting a bit weaker. So what is the probability statistics for this one is that market use this as a gauge whether if it's under forecast, again it's lower than 1.36 million, there is a 72% chance that the S&P or the index will decline in the following hour. And if there's an over forecast, surprisingly, even if data is better than expected, history shows that 75% chance that the market might decline anyway. So this suggests right now that stock investors are very sensitive to this data no matter which way it goes. It's because on top of that, of the current situation globally. And we have the housing starts as well from the US data. So here, again, the S&P 500 impact by this US economic indicator. So United States housing starts. So on the previous, here, we look at the permits, which is the paperwork. Right now, this one tracks the actual groundbreaking when shovels hit the dirt to start building new homes. So here, there's a big surprise that the recent report in March 12, it showed 1.487 million new projects started, and this was much higher than 1.35 forecast. So it shows that even if permits were down, actual construction was still booming. So they were still able to cope up regardless of the current situation. And so what we are looking forward right now is that experts right now or analysts are forecasting it might go to 1.40 from 1.48 now going to 1.40. So looking at again on the bar chart, if you look, you will see they're getting smaller, taller. So since the beginning of 2026, houses being started and still steady climbing. This is a sign wherein there's a very active construction sector. And the market impact on the index of S&P 500, once again, the market reacted on strong news from the last release. So what is the reaction is that interestingly, even though the news was good, more houses being built, the S&P 500 eventually you can see the red candles, it fell. Sometimes that too much good news makes investors worry that the economy is running too hot, which might lead to higher interest rates. And this one for the event versus the stocks that we're looking at. The green line is the housing starts trend and the blue line is the S&P 500 price. So by observing this, both lines are currently trending upward together. The green line has made a very sharp recovery from its low point in 2025, which often acts as a tailwind for the general economy. And again, probabilities for this one is that if it's under forecast, it's lower than 1.40 million, there is a very high percentage of 84% that the S&P will decline, and over forecast if the construction numbers are better than expected. History shows a 60% chance that the stock market will decline anyway in the following hour of release. On top of that, we also have another from the United States, which is the durable goods orders. So this data, um, these are orders for goods like cars, appliances, and machinery that are meant to last at least 3 years. This is what we're looking as well, how the inflation being encompassed here. It is a key measure of how confident businesses and people feel about making big ticket purchases. So here, um, last time it went to 1.4. The orders fell negative 1.4. The forecast would have to be negative 0.5. So it was much worse than expected. So what it was a rebound goal. Now, the next report would be on 29th, and markets are really hoping for a recovery back into positive territory at zero point 0.5, at least 0.5%. Because if this would be dragging the consumers right now, we expect really a news from the Federal Reserve that they might also have increased their interest rate if these are not already sufficing the reports. So the historical data right now, you see it's a very volatile right now. They jump up and down from month to month. So what is the trend that we're looking at here is that since the start of 2026, the trend has been mostly downward. That means before the war, it was already downward. And the big blue bar that we're looking at shows the most recent drop was the steepest in several months. So here is the steepest. So what is its impact? Now we are looking on the Dow Jones right now. How the Dow Jones reacted on the bad news last April 7. So after the initial news, the market spiked upward, which is a tall green candle here that we're looking at. This sometimes happens if investors think bad economic news will force the central bank to lower interest rates to help. So that is sometimes the twist wherein despite there is not expected good news because the federal might suffice all the reports. So in the event that we're looking at the comparison of the Dow Jones is that in our observation there is a major divergence here, while the green line, which is the orders, has been sliding down since early 2025. The blue line, which is the stock market, has been climbing steadily higher. So this suggests that the stock market is currently ignoring the weakness in manufacturing. So what is the probability for this one, the outcome? So markets look at these odds for the upcoming April 29 release, and under forecast, if orders are worse than 0.5%, it's a 50-50. Again, whether the Dow Jones goes up or down. That's why we have to wait first for the data, and over forecast, if the news is better than expected, there is a 56% chance the market will increase or rise. So if there's no forecast that we're looking at right now, curiously, in the rare cases when there was no forecast, the market rose 100% of the time. That is only the probability statistics based on historical records. Next, we have as well in Canada. So interest rate as well for the BOC. So this is the most important tool that the Canadian Central Bank uses to control inflation and the value of the Canadian dollar. Holding steady last March 18 here. So the BOC kept interest rates at 2.25. So this was exactly the market expected. And the next decision would be how the investors currently expect the bank to keep rate at 2.25 once again. So historical data, again, here, the trend, you can see a staircase moving downward. In early 2025, rates were higher around 2.75%, and the bank cut rates twice. Um, it cut rates twice last year in the late 2025, and first to 2.5 or 2.50%, and then to the current, which we're experiencing right now, is 2.25%. The pause here is that since December 2025, the bars have remained flat, indicating the bank is in a wait to see mode. That's why they need to look on the expectancy as well, how the market will play within the week, because we are really looking forward on the movements as well on the oil prices. So market movement. So the reaction, even though the rate did not change for the USD CAD, it fell sharply, which we see multiple consecutive candles, red candles. This means the Canadian dollar got stronger against the US dollar after the news, likely because of the bank's comments regarding the future policy. So this one, on the event that we're looking at, the green line, the interest rate, and the blue line is the USD CAD price. So observing this, the green line, it dropped, and the blue line or the currency pair become very volatile. Generally, when a country cuts interest rates, its currency tends to weaken, which explains why the blue line trended upward during the cutting cycle in the mid 2025. So probability, if it's actual forecast, the BOC does exactly what is expected, which is 100% of time in this data set. There is a 62% probability, decline probability for the USD CAD, but on the volatility, which is we're looking on the 1 hour chart, floating rate, there is 0.13%, which tells the traders or the markets to expect a moderate amount of price movement during the hour of the announcement. Now, we have also in the United States, the US interest rate. This is the market mover that we're looking forward. So this is the single most important event for global financial markets, as it determines the cost of borrowing dollars worldwide. So we expect more movements during the meeting or ongoing meeting of this event. So the recent pause in March 19, the Fed kept interest rates at 3.75%. This was exactly the market expected. And what is the big countdown on this is that the next decision in just 3 days away, analysts or markets are overwhelmingly predicting another hold at 3.75%, as the Fed balances high energy prices against a steady labor market. Now, looking at the forecast or actual or the historical data bar chart, the trend, looking at the bars from 2025 to 2026, you can see a clear downward trend, and the Fed was aggressively cutting rates throughout last year, moving from 4.5% down to 3.75%, which is the current. Now, the current stance for this is that since the start of 2026, the bars have leveled off. This shows the Fed has paused its cutting cycle to see if inflation stays under control. Now, we have the impact of the one of the indices, which is the Nasdaq. Mostly Nasdaq is very sensitive to this. Nasdaq is mostly comprised of tech-heavy stocks and reacted during the hour of the last meeting. So the reaction, even the rate did not change. The Nasdaq went on a wild ride. It initially spiked green, which is a green candle, and then crashed lower with the red candles. This happened because the markets or the investors were likely driven by fear by Chairman Powell's warnings about an energy shock and inflation uncertainty. That was ongoing back then. And what's the event that we're looking right now? The green line again, green line and the blue line. So the green line is the federal interest rate, and the blue line is the Nasdaq 100 price. So by observation, notice there is a massive divergence as the Fed cut rates. the green line going down, and the Nasdaq, which is the blue line, it rocketed higher. So tech stocks usually they prefer lower interest rates because it makes their future profits more valuable today. And what is the probability for this one is historical how the Nasdaq usually behaves on Federal Reserve Day. So actual or the forecast is that when the Fed does exactly what people expect, which happens almost lately, there is a 53% chance that the market might rise. And the volatility factor we're looking at is that 0.60%, 0.60% floating rate is much higher than the other charts you've looked at, like the euro or the housing. So this tells you that the Federal Reserve announcement is much noisier and more aggressive for investors or traders than most any other economic event. Actually, this one is more aggressive when you combine the announcement of Fed rate at the same time earnings report, the half year report or the quarterly report. Next, we have from the China how it would affect the CNH. So here we have the China National Bureau of Statistics Manufacturing PMI. So this one tracks the Chinese factories, this economic data. And looking this on a bigger picture is that its expansion. So the last reading was 50.4, which is great because any number over 50 means the manufacturing sector is growing. So a surprise reaction is that it beat expectations, 50.1, and now it's 50.4, and it's much better than the previous 49.0. So next at its update would be on April 30, and it might go steady to 50.2%. Just forecast of this one, it might remain on 50.2 steady. Now, historical trend again, in late 2025 or last year, China was still struggling. So looking at the bars here, it's was below 50. Now it's reaching 50 and showing a clear recovery in the factory activity. Market impact for this one, impact of USD CNH is that the reaction when the good news hit, the USD CNH fell sharply. This means the Chinese yuan got stronger because a healthy economy makes a currency more attractive. Probability of this, when this data is better than expected, the currency rises about 50% of the time. We also have from China, which is the rating dog manufacturing PMI. So this is from the Caixin manufacturing PMI and its immediate impact on USD CNH as well. So what is the market sentiment on this one? We have to look on its initial spike. So the USD CNH trended downward, indicating that Chinese yuan strengthened against the US dollar immediately following the data. So on a long-term trend, the graph tracks the one-year performance of the USD CNH here. So downward trajectory since early 2025, the pair has moved roughly 7.28 down to 6.81, showing a sustained period of yuan appreciation. And historical performance of this one is that it summarizes how the market reacts to these releases over time. So probability statistics of this one is that this event leads to a decline in USD CNH, which means the yuan may be strengthening, and 62.5% of the time, its market impact, its average floating rate or price move in the first hour is at modest at 0.041%. To summarize this, markets use this to gauge if China's manufacturing sector is expanding or above 50 or contracting, which directly drives the value of the yuan. Another is we have from the Japan this week, the consumer confidence. So Japan's consumer confidence and its correlation with the USD JPY exchange rate. So here on April 9th, release was a major miss, coming in 33.3 against a forecast of 38%. 38. Now, the sentiment right now, consumer optimism has deepened sharply and reversing the steady growth seen toward throughout the 2025 and up to the early first quarter of 2026. So, reaction on this one, this is the first 1 hour chart again. Following the weak data, USD JPY spiked. The green candlesticks show that the yen weakening as investors reacted to the poor internal economic outlook. Now, for the 1 year overview on a macro scale on USD JPY in a strong uptrend, currently hovering around 158 to 160 level. Now, on the trade statistics of this one, what is our key insight is that when this data comes in over forecast, USD JPY rises 75% of the time. And how we look on this is that market looks for these deviations to predict short-term volatility with an average move of about 0.10% in the first hour of an upside surprise. So a score below 50 again, it indicates a lack of confidence, and this recent drop suggests that Japanese households are tightening their belts, putting pressure on the yen. Now, on the euro area, euro, wait, you here. So for the euro, its immediate impact on the euro USD pair. So right now we are all looking forward if this euro USD would maintain the 1.17 to 1.16 level. So last time it was on 1.14. So the inflation trend right now is that last March 31, the release showed at 2.5% of the inflation rate and below the and slightly below the 2.6% forecast, but significantly higher than the previous 1.9. So what is the shift on this is that a period of cooling in late 2025, inflation is trending upward again, moving closer to 3.0% here. So here on its day of release, the Euro USD, we saw a high volatility and a sharp initial drop was followed by a recovery again. Here from here, there is a recovery as the market digested the under forecast expectations. And the 1 year view, looking at the macro, the Euro USD trending near 1.14. So there's a rebound from a significant dip in early as 2026 as Euro inflation data began to heat up again. So despite there was a drop, it was able to recover and back to 1.16 to be exact, and it was also during the start of the war. So trade statistics here is that when inflation comes in actual forecast or over forecast, there is a 60% probability of the euro rising within the first hour. The volatility, the average price movement following an over forecast release is roughly 0.08%, signaling a stronger reaction than when the data underperforms. So for the rising inflation, typically pressures the ECB toward a hawkish stance, which historically supports a stronger euro against the dollar. And last, for the euro, we also have data before the interest rate is that we have the GDP. Okay, gross domestic. So here, this is a growth rate year on year and its impact on again on the euro USD. So the result last January, there was a 1.3% beating the 1.2 forecast. Again, you can have overview as well of that. The IMF already downgraded the expectations or forecast for the growth of the euro. It's from 1.4, now it's to 1.1. Looking at the GDP growth, last time it was 1.3, and now we are expecting again on a forecast which is much different from what we are all expecting. So the trend, the euro has been seen steady incremental growth since early 2024. Here. it consistently outperforming expectations throughout much of last year. So the market reaction on the Euro USD here is that on the 1 hour chart, the Euro USD experienced a recovery. After an initial dip, the pair climbed to finish the 1.9215 here. From here to 1.92. So the trade statistics here is that the key risk, even when data in over forecast, the euro has actually declined 50% of the time in the first hour, and its volatility, the average movement for an upside surprise of 0.07%, suggesting that while growth is positive, the market often uses the news to reprice other factors. Now we also have the United Kingdom interest rate decision. So here, this is the policy stance that we're looking at. So 3.75, the benchmark or the repo rate. It is continued to be a pause that began in the late 2025. What is our outlook for this is that despite cooling inflation earlier this year, there are recent 3.3% and geopolitical tensions in the Middle East have shifted expectations toward a higher for longer stance, with the next decision this coming April 30th. And its impact on the here, sorry, why? Apologize for that. UK here. So here, sorry, this is a United Kingdom BOE. So for the 1 year comparison here is that here for the 1 hour chart first, the last March, the GBP USD or the sterling initially spiked to 1.335 before consolidating. So the market reacted to the anonymous vote and hawkish undertones regarding energy risks. For the 1 year comparison, so the macro chart that we're looking is that there are declines in rates which we see in green line. So from 4.5 right now, it's going to 3.75%, while the sterling has maintained a volatile but resilient range between 1.30 to 1.38. So statistically, when decision matches the forecast, the pound has a 56.2% probability of rising in the first hour. The volatility factor here is that the average 1 hour floating rate for a hold is 0.2%, indicating that even an expected decision can trigger significant movement as traders parse the meeting minutes. So BOE right now is currently in a data dependent mode and holding in a pattern. Next, we have the ECB right now. So here, the ECB is holding steady. So 2.15 last time, and the interest rate remain unchanged at 2.15%. So historically, rates have stabilized here after a drop from 2.4% in mid 2025. When the actual rate meets the forecast, as it has 16 times recently, the Euro USD shows a 75% probability of rising within the first hour. So all eyes right now are looking on the interest rate decision. So to provide on that, we have some key data that we look at. So it's still on a neutral or holding position, because on the market sentiment, we see right now it could be a bullish bias for the Euro USD and 75% rise probability when meeting forecast, and its average volatility would be 0.19% floating rate post release. Next, we have the United States core index. So the inflation is hitting up. The latest release on April 9 showed a month-on-month increase of 0.4%, maintaining a 3-month peak. So historically, when inflation hits the forecast, the Nasdaq leans slightly bearish with a 50% decline probability. However, we look on the release on April 30th. If inflation comes in under 0.3% forecast, data shows 100% historical rise in probability for the index. We expect higher volatility for this. So for this one, the under forecast would be 100% rise probability. Actual would be a decline if it's 53.3% neutral bearish. And an over forecast would be 80% decline probability or the strong bearish. Next, we have the US GDP growth rate. So these are the key breakdown that we're looking at impacting the S&P 500. And on the upcoming release, the market impact, the under forecast would be an 80% decline probability as well, and over forecast of 100% rise probability, and the current trend growth has slowed down from 4.4% seen late in 2025 looking at this bar. So if GDP misses the mark as it did recently, the S&P has an 80% probability of declining in the first R. Now, to provide an update right now from the energy. So here, this is the map of the Middle East. The IEA last week they already provided a report. So this is the gas market report, and it highlights a global energy crisis triggered by the closure of the Strait of Hormuz in March, which instantly wiped out 20% of the world's LNG supply. This supply shock drove gas prices in Europe and Asia to their highest points in 3 years, erasing the market stability previously provided by expanding North American production. So due to extensive damage to the Qatari infrastructure, the IEA now expect the anticipated LNG wave of the late 2020s to be pushed back by at least 2 years. So the report concludes that maintaining energy security will now require urgent international collaboration and aggressive demand reduction efforts, particularly through fuel switching in Asian markets. So here, to provide you a data or a table of how it would impact on the energy is that there are various factors contributing to a widespread energy crisis across the five major Middle East nations, and it identifies how military conflicts and targeted infrastructure attacks have crippled essential processing facilities in countries like Iran and UAE. So additionally, this document highlights how operational shutdowns in the oil sector have inadvertently led to a scarcity of associated natural gas in Saudi Arabia and Kuwait. Geopolitical tensions also play a significant role, particularly through the interruption of vital import agreements and implementation of maritime blockades. So here we categorize how these specific locations, such as the South Pars, which is very, very important, we are looking right now when it comes to LNG, and the Greater Bergen areas. And this data illustrates the localized impact of these regional supply chain disruptions. So ultimately, the source serves as a concise summary of the security and logistical vulnerabilities currently threatening the region's fuel stability. Now, what is the core problem when it comes to this oil gas link? So in the Middle East, roughly 50% of natural gas is associated with, meaning it has produced as a byproduct of oil extraction. Again, because Strait Hormuz is closed, oil producers have run out of shortage and have been forced to stop in oil production. When oil production stops, the natural gas supply disappears with it. So impact by country, again, by Iran, it's the regional giant, the status, the world's third largest gas producer, and provides 70% of its energy. The damage, right now, it knocked out roughly 12% of production, and the consequence is that internal supply is tight and exports to Iraq have been severely crippled. For Saudi Arabia, it's the third largest regional producer, so the production of oil it shuts in to 3.1 million barrels per day and have curtailed associated gas from major fields like the Marjan and Zuluf. So the silver lining here is that the new Jafura unconventional gas project is online and may help offset these losses since it does not depend on oil production. For the UAE, our major is the LNG exporter is now cut off from global markets. So the infrastructure that it has damaged, the drone and missile strikes. The current state right now, there is a domestic demand is currently being met, but export capabilities are frozen. Now for Kuwait, highly dependent on gas for two-thirds of its electricity. What is the supply crunch on this is that oil production is down by nearly 75% of as early as April, while Kuwait is prioritizing the gas, its LNG imports, mostly from Qatar, it have already declined or dropped to 55% due to the naval blockade. Last is that we also have the Iraq, a net importer. So the crisis, it relies on 40% of its gas in Iran. When Iran's infrastructure was hit, gas flow stopped, and the outlook right now is that plans to use a floating LNG terminal in 2026. We also have the last one is the Bahrain. So it uses all its gas domestically for power. The damage all as well the refinery. So following this, the Strait of Hormuz in March 2026, looking right now how the other countries were able to cope up with this crisis is that various nations implemented aggressive strategies to stabilize their energy sectors. Many Asian and Middle Eastern countries, such as Thailand and Egypt, prioritized restricting gas usage or transitioning back to coal fired power to manage limited resources. So, this is what happening right now according to the IEA update last week. And for us to summarize this, this is a wake up call for the global economy because it confirms that 20% of the world's gas supply has disappeared. This is not about expensive fuel. It changes how we forecast inflation and how central banks manage interest rates for the next several years. So this is the supply demand. So here, what are the important key points that we have to look up? There's a big shift on this, and we expected this year we expected a surplus of gas in 2026, but this report confirms that a gas glut is now delayed by at least 2 years. We are looking on the sticky inflation, so high energy costs acts like a hidden tax, making it harder for central banks to lower interest rates. And what's the long-term damage on this is because key infrastructure was physically destroyed, supply won't just bounce back even if the conflict ends tomorrow. And what are the market trends to watch? The commodities, if it's going to go up. For the bonds, the yields rising, and there's also a corporate stress because companies use a lot of energy like steel or chemical plants will find it more expensive to borrow money. For the stocks, we have also the winners or the losers. So for the winners or the bullish, we have the energy producers. And for the bearish or the losers, we have the airline, shipping, and manufacturing. They will struggle with massive fuel and electricity bills. For the currencies, we expect a strong dollar, so USD will still dominate because US exports energy in is seen as a safe place for investors. For the euro and JPY, it both may weaken because Europe and Japan must spend much more money just to import basic energy. And for the logistics and technology, new routes, so massive investment will flow into pipelines and storage tanks that don't rely on the Strait of Hormuz. So shipping costs, expect shipping prices to swing wildly as tankers take longer paths around Africa or other regions. So to summarize this update from the IEA is that the closure of Strait Hormuz has triggered a massive drop in global stockpiles, and this is leading to a trend where current prices are significantly higher than future delivery costs, reflecting an urgent need for resources that will likely to persist until trade routes reopen. Now, for the technicals, for the JPY, let's maybe begin. So we have a narrative from the Bank of Japan and the across central banks. So here, looking at this on a neutral trend, so my first resistance would be on actually 1.6 because it's already on 159. And looking at my Bollinger Bands, it's already touching my SMA. So first resistance would be 1.60.40, and first support would be around 1.5850, and second support is 157 level. So here, we are confronting the resistance of because BOJ's decision to hold steady on April 24 that was mentioned, yen remains under pressure. While the bank is currently neutral, they have signaled a shift toward tighter policy if inflation climbs to 1.5% toward their 1.7% target. So market sentiment for this is that it's currently battling the significant on the 160 flat level. The forecast is that a higher for longer stance from the Fed would also widen the interest rate gap and potentially driving the pair resistance toward 160.40 to 161. So key levels would be here 160 and 158. Next, we also have the Euro USD. This one is impacted by energy costs. So despite the central bank, use ECB, European Central Bank, maintaining the status quo on rates, the euro is being weighed down by rising energy costs and geopolitical war premiums impacting the region's economy. So the market sentiment here is that despite a minor bounce from recent lows, the pair is struggling to break the above the 1.18 level. Right now, it's still 1.17. Will it go back to 1.16 or go higher to 1.18 level? So here the forecast is that it's sitting 1.1723. So this is the trajectory for the euro and heavily on the USD strength. So any federal hawkish stance from the Federal Reserve, it could push prices back down to 1.16 again. So here we expect the euro before the rates to go higher to at least 1.17 flat. Next, we also have is the GBP USD or the sterling. We see this as sustaining upward momentum at the moment because the cable has shown notable strength following the April 2022 inflation. That is the 3.3% of the CPI, outperforming the euro in recent sessions. So the market sentiment is that the pair recently broke the 1.3485 barrier, this one here, and the forecast here is that we still see a bullish outlook and it remains intact at the moment as long as prices stay above around 1.34 1.3485 which was here, and with a medium target of 1.3710, and a break below this support could lead to a deeper retracement around 1.3314. So again, key levels here would be 1.3485. This is the support and it might go back to 1.33.2, and the resistance would be 1.3580 going to 1.36 at the moment. So this is our today's